Hello, and welcome to the CapLander podcast, where we dive into the dynamic world of private capital markets. Whether you're new to private market investing or a seasoned professional, this podcast unpacks the latest trends, insights, and opportunities shaping the industry. Featuring expert guests and deep discussions, CapLander is your go-to resource for staying informed and inspired. Today, Jody and I
are the expert guests.
We are the only expert guests. This is it. And we're actually coming live from
St. Louis together.
There we go.
Well, because Morgan, you just had a big birthday. Morgan turned 30
I did.
Yesterday. So
entered the Dirty 30 Club.
The Dirty 30. So I flew in to be with my daughter and our COO. And also we had an exciting day yesterday because we were featured in a Forbes article, which is really the first time where the Thelander name has been used, and not about our data only, but also about us being the story. So
it was a very nice hybrid. And when we spoke to Jerry, who wrote the article, she had also had experience with a family business. So there was a lot of synergy, and you don't really know what it's like to work in a family business, or it's hard to relate to somebody unless you've done it. She definitely understood that, and it was fun to talk to her.
Yeah, because she asked great questions around, like, how do we separate boundaries from personal time to business time? And I think she took a particular affinity to that because she said there were times where she had to talk to her own mother. And I know that there are some times that you call your grandfather, my father, to try and...
That was a good question. She goes, well, how do you deal with conflict? We both kind of sat there and go, well, boundaries. And then the other part is, she goes, well, do you bring in consultants to mediate? And we go, no.
We try to keep it all in the family. So
literally.
But the article was great because it talked about the 30-year business and you as the COO. There was a lot of nice things said about both of us, actually. So that part was very humbling.
First time we've been in an article together.
Yeah.
So that's been very exciting. And as Jody said, it was not just about, there was compensation data, gender compensation data for women and venture and private equity and how they're stacking up to their male counterparts. But then there was a whole part of the article that was really just about how Jody started the business, and then when I came into the business, and then what challenges were and defining moments was the big thing.
I think the challenges were very important, and the reporter, Jerry Stengel, was very interested to understand that, because you'd be lying if you didn't address the fact that it wasn't always easy, and that there may be times when, especially you're a founder CEO, that you might wonder if you're going to make it, but you have to have that strength of conviction and undying belief in yourself and what you're doing and how you're helping the market, like what services you're providing and the value, right?
Remember when I graduated from college and the commencement speaker was the writer of, and one of the writers and the creator of Modern Family, the TV show. And he really talked about it, always stuck with all of us, because he said you can't fail more than 11 times in a row. And he had said that he had piloted 10 other shows before Modern Family, and Modern Family was obviously extremely successful.
But he said he took his daughter to work with him one day, and she sat in the writer's room with him. And then she came home that night, and the mom asked her, well, how did it go today? And she said, it's a wonder we have a roof over our head. If that's what goes on with dad with work, that is keeping us in this house.
So these are... With the podcast being, we've kind of moved past the initial inaugural season of it, and really where what we wanted to talk about today was recap really the last week or two, and then go into what's coming down the road. So one of the things that we've read the most lately, and that's come up from our PR team to us too, has been a lot of talk about family offices. And the article in particular that really we saw the most that resonated was the rise of the family office from Term Sheet with Ali Garfinkel.
Well, we've done consulting for family offices, and in the investment firm survey, we have...
So when somebody comes to you for consulting for a family office, what are they coming to you for?
Yeah. So what it means is that if you are raising your capital from a family versus raising the capital from a corporation or from different limited partners, LPs, that you are investing, and obviously the sole purpose is for financial return. But it has been a different comp structure historically, in that maybe the family office thought that they were just going to have compensation around the cash side and not on carried interest. And that seems to be changing and becoming more like a venture firm.
Family offices and corporate venture firms, I would think corporate venture firms obviously get their capital from one place, from the parent company.
Right. So this is the part of it. So when you ask about the consulting, the family offices are coming to us saying, well, we're not raising the funds because we're getting it from the family office. And that is like a corporate, but we do absolutely want to have some skin in the game. We want to have a long-term incentive that ties the success of the investments to the success of the individual investors or the fund itself. So they want what's called the carried interest, which is part of the proceeds.
And that probably leads into the next part, because family offices reference the term sheet article, but then in Pitch Book, there was talk about how corporate
Right.
venture firms and how active corporate venture firms have been in the marketplace, and as active as they've been, how much more activity there's been with corporate venture firms. It hasn't really resulted in more M&A activity.
Right. So corporates, for those of you that are listening, just to make sure that we all have the same understanding, I mean, it's the investment arm of a major corporation, and that can be structured many different ways. It can be a separate entity. It can be an off-balance sheet. It can be just money deal by deal. But the essence of it is that these funds are coming just from the parent company, and they're not raising capital from outside LPs. And that despite all of this, that is not resulting in more M&A transactions, even though the CVCs are a really integral part of the investment ecosystem, because there's a lot of money that goes into it. And the innovation that comes from these companies that are being invested in by the CVCs, extremely important. But you would have thought that there might be more liquidity or some kind of end game. But right now, things are just slow.
I mean, it's just slow every which way. And I think that there's a lot of uncertainty about I'm not hearing anything about any companies really going public or thinking about going public. I'm hearing much more about companies thinking about M&A activity than they are thinking about the IPO market.
Let's face it, the IPO market is really still about raising capital.
Right. It's the last private round.
Right.
It's the last private round. And that's really where companies come to it, me at least, or when I hear this on demos, is they say, well, I'm getting ready to go public. Should I use a mix of public and private data, or should I just be using public data? My answer is you should be using private data only.
Right, because you want to make sure that your equity is in the right position, because it's the last time that you can do that without a public company comparator group.
Right.
What's happening with CVCs and with family offices is that family offices are often coming from, in today's world, the family money could be coming from founders and successful entrepreneurs that have had exit.
The article talked about Mark Zuckerberg, Sheryl Sandberg, obviously, who were very successful. Sheryl Sandberg from Lean In, and then also from Facebook too.
Right.
And those are families who are not generational wealth, but the article did talk about how, and this is a quote from the article, is that family offices are operating over time horizons of 50 to 100 years.
Well, the reality is that some of these new family offices are coming because there's been wealth creation from individuals because they've been successful in either public companies or private companies that then went public, and they want to still be entrepreneurs and stay relevant in the private markets. And so while they don't really care, there's not many, since the money is theirs, they don't have to worry about a carried interest because they have the bulk of the investment. But as they're hiring people in order to be competitive and attract and retain the right people, sooner or later, it begs the question around carried interest. And that's where we've been busy on the consulting side. And it's also, I think, very realistic for a family office to make sure that they're thinking about their trajectory. And at some point, they're going to have to incorporate a carried interest pool and figure out what the vesting times are going to be. And if they're going to have a capital contribution, all the good stuff, the complicated stuff, but all the good stuff. And there's no one way.
No. Okay, I'm going to move on to, we wrapped 2 webinars in the last couple of weeks, and we have 2 more coming up in the next week or 2, depending on when you're listening to this, is the end of February. But one of the webinars that we had was the private company compensation panel webinar. We had the CEO of R3 Vascular join us, and we also had a lawyer on the panel.
God, it was so busy. I mean, when we say a webinar, the fun of it is that we start with a few overview slides on compensation.
We always pull data fresh.
And the Thelander surveys, right, and how we do it. We pull data fresh. And then once we get into showing a little bit of information, it's like wildfire. There is constant discussion on the chat, right?
And we take one question and 3 more pop up.
Right. And that's the fun of it, though, is that we pivot and we really follow what the listeners want versus we don't have a set agenda.
I think actually in a lot of ways, we do a lot of in-person panels, but the webinars are actually more productive a lot of the time because people
want to be, really don't want to be known for the question or known for if they have some pressure point.
Right. But a lot of the questions that came up this time were about revesting, when to revest, upping somebody's equity, and then what types of equity to grant at certain stages.
So on the investment firm side, you have carried interest, and that is the long-term incentive. So you get a piece of a whole fund. On the private company side, you get equity. So you get a piece of the private company, and you get this both as an executive, you could get it as an employee. And what's been happening now, since the fundraising's taking longer or the rounds are bigger, people could be fully vested, because it's a 4-year vesting typically, with you have to stay for 1 year before that clock starts ticking.
Which is the cliff.
The cliff, right? But the 4 years comes and goes, and you likely have not had a liquidity by then. So
look at all these companies who have raised an unbelievable amount of money, and there's been no liquidity at all.
Yeah, companies who have raised over $300 million and still staying private. But beyond that, you got to figure out, if you want to keep people engaged, what do you do? And also, let's say you raised around at a certain valuation.
That was my next.
And now the valuation's gone down.
Right.
And so you have what's called a down round.
Right. Or when it's underwater.
Well, it's the same thing. Down round is underwater.
Right.
And so this comes up all the time. Like, what do you do? Because you want to make sure that the people who you care about.
What do you do?
Well, you want to make sure that they can't give more equity to everybody, because there's only so much to go around, right? Because the investors put in their money, and they require a certain amount of the equity of that option pool. And at a certain point, if you're going to give more to somebody else, it has to come from them. And that's not going to be realistic. So there's only so much to go around. You can't give everybody equity to make them whole again, but you're going to have to give somebody something.
Okay. So a lot of the questions that come up too, and we've talked to a number of reporters about this, is we're seeing more equity being given much farther down to staff level employees who are getting much more savvy about saying, well, I'm willing to take less cash and more equity.
I don't think that's right. I don't agree with you.
I
don't think that anybody's willing to take less cash in order to get more equity. I think the good people want more cash and more equity.
Correct.
Are they greedy or are they smart? I think they're smart.
No, I think they're smart, because I think especially in states that have pay transparency laws, where they're much more versed in the fact that it has to be. And also, we know that younger generations are much more comfortable to talk about.
Let's face it, they're more comfortable to talk about everything. That's part of the deal. But I do believe that it's not only pay transparency, it's just that you know that getting equity is not going to turn into wealth. There's like those days of .com and hit it and quit it and the go, everything going fast. I say this every time.
Yeah.
Those days are over. It's not going to happen again. Too many people got screwed. Too much money got lost, and it's not going to happen. So now we know it's a long game, and you can't live on equity, and you want the cash. But if you're with a good company and you are you believe in it, then you want both.
You want skin in the game. I wanted skin in the game. I mean, there's skin in the game for a couple of reasons for me, partly because my last name is also your last name. But yes, the last thing I really want to touch on is that not everybody, but there's a lot of people who are talking about the Let Them Theory by Mel Robbins. And when I listened to the podcast that she put out, the first thing she said about putting the actual Let Them Theory to practice is the first thing that she said in terms of a lesson of it is that you have to negotiate a job offer.
Well, she said you can't let them if it is going to cross a boundary for you. And one of the examples, the first example that she gave, we both listened to it and we both caught it.
Right. Like,
she said you can't let them walk all over you or not pay you fair to market. And it was such a, it's on everybody's mind.
A lot of people don't I don't know the exact number that she gave, but it was a very high percentage of people who don't negotiate a job offer.
How can you not negotiate? I don't get it. Like, if I offered you something for $5 and you just say, okay,
that's $5. I'll take that $5. But the part about it that
I'm like, I'll take $7. Thank you.
Well, you have to go much higher than you think that they would even do to reel it back. It's a game of chicken.
Right.
But I thought that was really interesting, because that's really where Complander, which is a division of J Thelander, collects job offer data.
Okay, so that's CapLander.com in case any of you are interested. And that would be for those of you who are junior all the way up to the mid-level, because we'd appreciate that at the top level, at the senior levels, as chiefs and VPs, that it's more than just getting the data. It's also other questions around
expertise and trends. You want to see all of this.
well, and what's going on inside of the actual company where you're going to work. But at these mid-level down to the entry levels, it's pretty consistent. And it's important to understand what the market data is telling you and to figure out where you want to be on that or where it's appropriate for you. And that's what CapLander does. It vets the data from our main business for the mix between either cash and equity or cash and carried interest.
So if you were, we're going to give you a scenario. You're 22 years old or 21 years old and you graduated college and you're super excited because you got offered a job at a startup in Chicago, right? How do you negotiate your salary? What do you do?
Well, you go to CapLander, ideally if it's a private company.
Data.
Yeah, and you get some data to see what is the market telling you that job pays.
Okay, but you go to the employer. And what do you go back
first, you got to get the data.
Okay.
And then you go back to the employer. And if your compensation, let's say they offer you $100,000 and the market data,
they tell you, I'm giving you 30,000 shares.
You need to know what percentage of shares, because if there's 50,000 shares available and you're getting 30,000, then you're in good position.
Booyah.
If there are 3 billion shares available and you're getting 30,000,
no bueno.
Terrible, right? You're at the low end. So you need to know what percentage of fully diluted shares that is. So you have to ask that question. Now that also shows that you're sophisticated and knowledgeable.
Right.
And then you want to understand what the valuation was. So what is the strike price? Meaning if you were going to buy that equity, what would it be? And then you also need to understand the compensation. Is it all base pay? Is it base pay plus a potential bonus? Those questions are important.
Salary increases?
Yeah. I don't think you can ask them what a guaranteed salary increase.
No, but you could ask, do you give salary increases? And if there is a bonus program, is it tied to a performance evaluation? Are there metrics?
You got to ask a bunch of different questions. But the main thing is to make sure that your starting point, you've got to make sure that you're being valued out of the starting gate. So very important.
Okay. So that's really key to understanding compensation. The same thing really goes if you're on the investment firm side, whether you're at a venture firm, even private equity, corporate venture.
Even trickier.
Yeah, it's the same thing because we survey carried interest percentages for all active funds, and we also survey carried interest for most recent fund, but then we also survey carry dollars at work. And we've noticed with a lot of investment firm clients that they give the lower level positions or the entry level positions up until the director level. They won't necessarily give you the carried interest percentage, but they'll do the carry dollars at work because the carried interest percentage will be
the carry dollars at work
seems higher, right?
Yeah.
Because it's if the fund achieves a 2 times gross multiple.
Yeah, I mean, you're talking in pretty sophisticated terms, but
there are resources for all of it. And I think the reality is it is sophisticated, but if you also are listening to it and you don't understand that there are resources to become knowledgeable.
And you should, because on the private company side, there's more competition for those jobs and there's more jobs available.
Right.
On the investment firm side, there's more competition for the jobs and there are not a lot of jobs because the investment firm jobs are fewer and far between.
Right.
And regardless, in either case, you want to make sure you make the right step. You don't want to have to leave the firm in order to get to the right position. And that's what we've seen happening, which is why it's so important that people have access to the information and that you use it. Everyone says this all the time, that information is power.
Right.
And the data-driven decisions, there is no reason not to be making those. So I'm going to pivot now.
Okay.
Let's move forward. What do we have on the horizon?
So on March 4th, we have a private company compensation and valuation webinar. And that's really going to be exciting because we're partnering with Scalar, which is the premier valuation. And they do tax services and auditing too.
The valuation is really important because it's not only what you own, but it's how you own it. So again, like Morgan said, if you have 30,000 shares, you need to know what percentage, but then you also need to know what is the valuation of that data because there are tax consequences with that. And that this is all the different nuances for the private markets.
What makes it unique.
Yeah. And Scalar does a really nice job because there are some companies that everybody uses, and this came up in the beginning when we did our first CapLander podcast. And you asked me why I never raised capital. I said that because this is a long game and slow and steady wins the day. That's what I really like about Scalar is that they have been slow and steady. There are other firms that have cap table management and they've raised a lot of capital and they raised it fast. We heard on a call now twice this week that the quality is starting to be questionable because they've come up with answers that don't make sense. So I think it's really important that you make sure that you do your homework because it is important for you if you're going to get
really
equity
matters.
and you find out that your valuation isn't accurate, it could have all kinds of consequences.
It's
So
also not good in terms of the relationship with the investor because a valuation is something you need to get done every year. So
I had dinner with my nephew the other day and I asked him, unfortunately I have 3 nephews, so nobody knows which one. And I asked him about what percentage of equity he has and he doesn't know the answer.
Right. I don't think that's uncommon. I really don't. I don't think that's uncommon.
Crazy to me.
Okay, so compensation and valuation webinars on March 4th. And the next one that we have is our first CBC compensation panel webinar of the year. But that one's going to be with a lawyer and then an industry expert who's actually with a firm. And those
we like the lawyers. I mean, I've had 2 husbands, both lawyers, current boyfriend.
Lawyer.
Okay, so we like the lawyers. They seem to add some levity to the situation, some anchoring of stuff.
It's all around that you're working with the same. It's the same thing with the pitch book partnership. Is it's all the same people covering the exact same industry, just from different angles.
And all the angles do matter, though, right? Because we like the lawyers involved in our discussions, along with the industry expert in that area, because they really do have
concrete answers.
And you need to know the legalese around it. There's no question. Boards want to know, and companies need to know.
Clients a lot. I go, who do you use for legal? And they just start listing names. They go, wait, like this firm for this, and this firm for that, and it's everything else. So I don't have anything else. Do you have anything else?
No, I'm really proud of you from this week. First of all, your 30th birthday and here in St. Louis with you. And second of all, the Forbes article was really impressive. And I will wind up with, actually, there was a quote at the end that our friend Cammie Samuels gave, who's at Venrock, and we've known Cammie for many years. She's a total rock star. She came from Versant, and she said that Morgan, although she may be young in years, that she has all this wisdom and the same chutzpah as her mom. So on that note, here's to the chutzpah.
Thank you for
the other webinar. Thank you.
See you soon.